historically speaking, the 10-year yield is at 4.6%, which means it is way higher than its usual normal average. You can see over here that since the start of 2023, it was consolidating over here, and then it went really high around 5%, and then it is right now trading in the downward channel. But what usually happens is the higher lows that is forming in this downtrend. Now this is very concerning. Why? Because we broke this downtrend over here. We tried to break it over here. We tried to break it over here as well. But finally, we have this 2 to 3 week, confirmed breakout over here. So when the 10-year yield, which is the flight to safety, so that people call it as, what is the cost of capital? The cost of capital is basically the 10-year yield in which you can get, 4.6% guaranteed, as long as US doesn't default on its debt. So that is, the risk-free, risk-free rate of return. So when you have a risk-free rate of return such high as 4.6%, it makes the capital markets, that is equity markets, very less lucrative. So when you have a risk-free return of 4.6%, you will be less inclined to take risk in the equity markets. So this is very concerning. So especially when you are having an institutional investor and when you are, handling billions of dollars of funds, you would rather park a significant chunk of it in this 10-year yield or the 10-year bonds, so to speak, as opposed to equity markets, which, provides a downward pressure on equity markets. So on one hand, you have, a downward pressure from the bond market, right? And on the other hand, the gap on the upwards trend, nobody knows what it is. So this is very concerning. So I just wanted to discuss this because the capital markets are, consisting of bond markets, commodities, equities, but all of these assets are, correlated. So there is a negative correlation between bond markets and stock markets. So if you have such high lucrative returns in the bond markets, then naturally there is a very less incentive to go out and take risk in the capital markets. So I just wanted to point this out in detail because this 10-year yield, a lot of other things are dependent on this 10-year yield. So for example, you can see over here that the 30 years fixed mortgage rate, that is still sitting at 6.91%. That is almost 7%. So a lot of other things are dependent on this 10-year yield. So as long as this 10-year yield, is relatively high, this is going to put a downward pressure on the equity markets.